Hey, Rebel Bankers, this is your host, and welcome back to the Real Estate Money School. I'm excited. I've got Marco Santarelli with me from Norada Real Estate Investments, and he also, when he told me this, I was really excited because I've heard of this a lot. He also runs Passive Real Estate Investing. If you haven't heard about that, it's a podcast, it's a website, it's a book that's on its way out. A lot of stuff to talk about, but Marco's got a crazy story you guys are going to hear about. But before we get to Marco's story, let's talk a little bit about your journey to becoming a Rebel Banker. So we talk about this all the time. The journey is not an easy one, but the journey is one that you will never, ever regret doing. And that journey always begins with knowledge, but not just knowledge. It begins with application of knowledge. If all you do is go out there and search for knowledge, you're never going to ever get off the ground. You have to apply knowledge in order to have success, and there's no two ways about it. And if failure is something you're scared of, stop being scared of it. It's going to happen. Just get it out of the way and then start that journey and go on with that. And that journey can start with lots of different things. Could even begin with just grabbing a copy of a book and reading that book. The Private Money Guide and Mapping Out the Millionaire Mystery are two great books that will teach you about how money works and about how you can become your own Rebel Banker and be in control of your money. So with that, let's get into Marco. Marco, thanks for joining us.
Thank you, Chris. It's an honor to be on your show, so thank you.
Oh, absolutely. Well, tell a little bit about your companies. You got the two companies. What do you guys do? Like, tell the audience exactly what you guys do on both avenues.
Well, thanks, Chris. So the short answer to what we do as a company is we help individuals, people, build their real estate portfolio. The question is, why would you want to build a real estate portfolio? It's very simple. You want two things. You want passive income because that leads to financial freedom, which ultimately leads to time freedom. The second thing is to create wealth, because those two things, if done right, go hand in hand. And with real estate, as you know, real estate is one of the greatest wealth preservers and wealth creators. So what we do is we help people build their real estate portfolios. The longer answer, just to tack onto that real quick, complete the answer, is we operate in 25 different markets in the U.S. So we provide people with all the education and knowledge they need to be successful real estate investors. We have all the resources that we hand over, vetted service providers that we work with. And then last but not least, we have anywhere from 100 to 200 properties available at any given time in those 25 markets that investors can pick and choose from to build and add to their portfolio so they create that passive income.
Well, that's great. So what is the difference between the two companies? So Norada and then the passive real estate investing.
Yeah, interesting question. I don't think I've ever been asked that question. So the core business is Norada Real Estate Investments. That's the business that we started 16 years ago. And that's actually an interesting story on how that came to be. But 5 years ago, I decided, you know what, I need to get my message out with a megaphone, not just one-on-one, which is what we were doing on the phone with investors who would find us and call us and say, hey, I love your service. I need that help. How do you work? So I realized that I either need to do a YouTube channel or a podcast because I needed to get the message out to more people in a faster, more efficient way. Instead of one-to-one, I had to go one-to-many. And that's the way the podcast started. So yeah, it is a separate business, but really it's a sister, if you will, to the core business because it allows me to pass the message and educate people about how to become financially independent, financially free in a much more efficient and effective way and in a more personal way, actually.
That's awesome. I love it. Well, all right. So let's do this. I always like knowing someone's journey. So that's great that you've got these businesses. You've been doing it for 16 years though. Like, how did all this start? Take us back on a journey to like where this began. What was your first deal like and what struggles did you have along the way?
Yeah, so that's a great question. And actually, those are two different questions because if you really want to go as far back as to where I actually started, I was an 18-year-old. Somewhere around 13, 14, I knew that I wanted to be financially independent. I wanted to learn how money worked. So I studied money, business, investing. I just needed to figure it out. And I did it on my own, and which was kind of a weird thing for a kid to do. You call that kid kind of an introvert or a nerd. Well, yeah, I was a bit of an introvert, and I was kind of nerdy. But the thing is the concept of freedom fascinated me. So it wasn't about the money. The money was only the vehicle to get me to the lifestyle and the place I wanted to be, which was financial independence. So I looked around and I observed that the people who actually had the most flexibility, freedom, and sometimes wealth that you could see, although a lot of wealthy people I knew actually didn't flash anything. They drove around beat up pickup trucks. But I knew that they owned a bunch of duplexes, in different places in the city I lived. So I decided to study it. And then ultimately, when I could qualify for financing at the age of 18, I went ahead and I bought my first rental property. It was an N-unit townhome. And why 18? Because I could qualify for financing. So I already had it teed up in my head. I was thinking about it, but then I did it. And I bought the property, fixed it up, put a sign in the lawn. There was no internet back then. It was a lawn sign and the newspaper. But I interviewed some people, and I didn't know what the heck I was doing. But ultimately, I picked somebody, placed them in the property, and I collected the monthly rent. And I held that property for a number of years. And a lesson learned and kind of a nugget for your audience is this: the mistake I made on that deal was not so much the buying of it or the leasing of it; it was the selling of it. I didn't know what I knew today back then. What I should have done is kept that property literally forever, and use the equity gain that I took out of that property when I sold it to leverage into more real estate, to build my wealth faster, to increase my cash flow. I didn't know that back then. I just thought, wow, I did great. Maybe I'll do this again one day. But you never sell real estate. The only time you sell it is really to repurpose the equity into more real estate. So that's the answer to your first question of my journey, where I started personally. Where I started with the business is actually even more interesting, because what I did is in 2003, when real estate was on fire and everybody and their dog and the taxi driver was a quote unquote real estate investor, scary days actually in hindsight, I decided to go back into real estate. Now I was investing on the side, but I decided to go full time. And so I started investing in real estate in markets that were over 2,000 miles away from my home here in Southern California. And in the process of doing that, I was going through the same boot camps and webinars. Well, I don't think they were webinars back then, but seminars as other real estate investors. But I bought 84 units in a 9-month period. And as I started doing that, investors were coming to me saying, "Hey, Marco, I see what you're doing. You are actually taking action and making it happen. Can you mentor me? Can you coach me?" And my answer was always, thankfully, "No, I'm sorry, I can't. I don't have the time." And I honestly didn't. But that's when the light bulb moment went off. And I realized, wow, there's a lot of people spending time and lots of money to the tune of tens of thousands of dollars on these boot camps. And they wanted to invest in real estate. They were taking the time and energy learning how to invest in real estate, but they weren't pulling the trigger for whatever reason. I don't know if it was fear or they just didn't know how to find and underwrite or analyze a deal. But I was buying a lot of stuff and I was looking at a lot of deals and I wasn't buying all of them. So I had the deal flow. So I started to pass that along to other investors. But I structured a business around it because I am an entrepreneur. And I said, "Hey, I'll do 70% of the work for you. I'll find the deals, I'll vet it, I'll introduce you to the right people you need for financing and property management. And here you go. It's all on a silver platter. You take it from me and I'll charge you a small fee." That's how the business was born. Shortly thereafter, and as of today, we don't charge a fee at all. Our services are 100% free. I started off by charging a fee, and I quickly changed that because I realized if I became a real estate broker, I can now charge the seller, who's our partners, essentially what you call the commission, and we build our revenue model around that. So long story short, that's how it all came to be.
I think that's a great story. And I love how you started so young, because a lot of people would never even think about doing that. But, it's like I read a lot of books and I read some books about some investors, and they started back in their late teens, early 20s. And it was always the same. No idea what they're doing. Go in, you do all the work yourself. You slave over it. You got it done. You're just learning every step of the way. I mean, what are some of the biggest mistakes you've made in your journey and in this career? Outside of selling that property, because that was a big mistake.
Well, we all make mistakes, and the thing is you have to make mistakes to learn. It's hard to grow without making mistakes. In fact, I was just talking about this an hour ago. In order to become a champion or a winner at whatever you're passionate about, you're going to fail. You're going to fail along the way, and you have to fail to learn, because that's going to springboard you to the next level. So you need to fail. You need to fail frequently. You need to fail forward, and you need to fail fast. So make the failures, get them done and behind you, pick yourself up and continue on, but learn the lesson from the failure so you can fail forward and grow. So there's always a lot of mistakes. I mean, one of the biggest mistakes I made early on, being in Southern California, investing 2,000 miles away, is the acquisitions person. There's 5 key people on your team, and the first person is the person that's going to provide you the deals, the acquisitions company or acquisitions person. Well, I made the mistake of turning that acquisitions person into the second most important person on my team, which you could argue is the first most important person on your team, and that is your manager, property manager, which has to be a professional, full-service property management company. You have to have the whole package. It can't be a real estate agent that moonlights as a property manager, and that was my mistake right there. So my acquisitions person, which was my real estate agent at the time in one of my markets, doubled up as my property manager. Well, she didn't do either one of those incredibly well. She did them both okay, but she didn't do a great job at both. In fact, as time went on, it got worse. And then it ultimately culminated to the point where I had acquired a 40-unit apartment building, and she was my property manager there as well. Well, what I didn't know at the time, but became apparent pretty quick, is she was collecting rents. And in that demographic, that area, most people paid in cash. So she was collecting cash, and she would have thousands upon thousands of dollars of cash. And she was sending it to me via UPS at the beginning, but then all of a sudden these UPS packages started to disappear, and there was one package that was supposed to be $6,000 of collected rents that never showed up. So I asked her, I said, well, send me the UPS slip. Well, that didn't exist either. So, you connect the dots yourself, put 2 and 2 together here, and you realize that she was skimming my rents because it was cash, and I had no control over that. So the lesson learned from that mistake is make sure you have a separate property manager, and that property management company has to be a qualified, vetted, licensed, professional, full-service property management company, because then there's no collusion or misrepresentation.
Yeah, that's a big lesson. A lot of people make that mistake. They just get somebody and they just put that person in place, and that person is not qualified to do what they need to do. And then all of a sudden they start thinking there's these little loopholes and these little things they can do like that. I mean, that's a lot. That's very difficult to recover from. So here we are. We're in the midst of the 2020 COVID, whatever you want to call it, economic recession, depression. It goes by lots of names, but here we are.
Right.
The markets are crazy. I mean, one day the stock market's up, the next day it's down. We just can't put any logic to it, but it's new. This is brand spanking new. It just started. So being a real estate investor, knowing what's going on, having been through multiple recessions already, because you went through 2008 and 2009, what would be some advice, because you're in the multifamily space, what would be some advice you'd give to people going into this? Like, what would be some key things that they should be doing, looking at, and really taking advantage of right now?
That is a great question, and I literally mean it when I say that we could talk about that one thing for about 3 hours. There's just so much to unpack. You've opened up Pandora's box. But I'll give you some high-level, really focused advice, if you will, on how to be an effective real estate investor and protect yourselves from fluctuations, whether it's an economic fluctuation, a recession, even a depression, a local real estate market cycle. First and foremost, there's just so much here that I want to share. First and foremost, you really need to stay focused on the big picture. Some investors make the mistake of being presented a quote-unquote deal, and it's this property that looks great on the outside, the inside. It was probably renovated, and the numbers look good on paper. Maybe it's leased and they're actual numbers, or maybe it's to be leased and it's pro forma. But in either case, it looks like a good deal, and it may be. But what they fail to do, and these are mistakes I've made personally early on, is they don't step back to look at where is this located? What is the street like? What is the area like? What is the neighborhood like? And more importantly, what is the market that it's in like? So if you reverse this, it really becomes what is my 5th rule of my 10 rules of successful real estate investing. It's taking a top-down approach. So you have to think of it like a funnel. When you start at the top of the funnel, you look at the United States and you say, okay, big country, we have 405 metropolitan statistical areas. Each and every one of those is a big area in itself. And so what happens on one side of it is different than what happens on the other side. But that's where you start. So you start with a market. You choose the best market to invest in. And the way you determine that is you look at the fundamentals and you look at the dynamics. The two most important things that investors really should look at when it comes to that market is, what are the jobs like? What's the job environment? Are there jobs, and is there job growth? Because people live in a market because of the jobs, and they stay or move to that market because of jobs. It's when jobs disappear and employment goes high that people start to move out further and further away until they can find employment, because you can only live so long without income. So jobs is critically important. And the second thing, which is tied to the first, is the population growing? Is there migration, positive net migration? Is there organic growth? Because that leads to demand for housing. And if you have demand for housing, it keeps prices up or pushes prices up, it pushes rents up, and it keeps the housing market healthy and strong. So you do want to see growth, whether it's organic growth or net migration. There's a lot of other things that play into that, but that's the starting point, is the market. Once you've identified the right markets, then you start looking at the submarkets and neighborhoods. And if you can do that, you've eliminated 70 to 80% of your supposed risk as a real estate investor, because the market, and especially the neighborhoods, play heavily into the success or struggles that you will experience as a real estate investor investing and buying properties in anywhere in the U.S. Me personally, and what we focus on as a company, I like to stick to what I classify as a B plus neighborhood. Now we're in the B minus, the B pluses and A minuses. That demographic, that range, plays in very well to give you a good demographic of a tenant, appreciation potential, and good cash flow. So it's kind of like a hybrid. It's a mix of all those things together, and it works out well. So the market, the neighborhood, then you look at the property, then you analyze and underwrite the property. When you have the right ingredients, that mix coming together, you've done 80% of your due diligence, and you set yourself up for success. Now it's a matter of the team. Do you have the right property manager, the right lender, asset protection attorney, and tax advisor? So I know that's a long answer to your question.
That's okay.
But if you do that, you do mitigate risk, avoid making mistakes, and you will avoid stepping on landmines that a lot of investors make. So you really have to step back and look at the big picture and look at all the layers, not just the property by itself. So I'm not sure if I answered your question.
Yeah, I love the top-down approach. I mean, that's really where everything should start anyway. But, in doing this too, the other question I have for you that I didn't ask the first time, but this should be an easy one. There's a lot of people when they're first getting into this, or they've been in real estate for a little while, maybe wholesale, flipping, whatever they're doing. They're always, we all want these big multifamily properties, right? But right now they're very overpriced, in my opinion. The big multifamilies, there's a ton of 1035 exchange money or 1031 exchange money going to them. I always confuse the same codes, but 1031 exchange money, driving price up. They're trying to avoid paying tax, because a lot of people are exiting properties right now at the top. Smart, right? A lot of people are getting out, and it's keeping these prices nice and solid. Now, doing that, when someone's new to this and they're looking at that multifamily space, what would you, and this is maybe a tough question, but if someone's saying, okay, I want to get into the multifamily, should I really focus on just the bigger complexes, or should I look at singles, doubles, quads, and build a portfolio with that and then transition? What would you say to somebody looking at that?
So before I answer that, let me get a better understanding of your audience. Are your audience focused on one more so than the other, or is it across the board?
Across the board.
Okay, so I'm going to break this down into two parts. So it's kind of a two-part answer. You've got income-producing real estate that is what we refer to in the lending world residential, which is your single families, duplexes, triplexes, and fourplexes. Anything in that bucket or that category is referred to loosely as residential real estate. And the reason for that is because you get the best financing terms. Mm-hmm. And it's also the most abundant. As you get into larger and larger real estate, meaning more units, it becomes more unique and less abundant, and in many cases more competitive. And that's why you see cap rate compression in the multi-unit space. So that other category, that other bucket, is what we refer to as multi-unit residential, and that falls under commercial lending. So it's a different type of financing. My preference and my favorite, where I spend most of my time and energy and money, is on the 1 to 4 unit. And coincidentally, that's as a company, Norada Real Estate, that's where we focus, is because it is abundant, it provides the best financing, it provides across the board the best returns. It is the most liquid within the asset class of real estate, which happens to be a fairly illiquid asset class. There are a lot of benefits. Now, I'm not saying multi-unit is bad.
Oh,
It's
I
just
love where this is going. And I didn't think this was going to be your answer. I love this.
okay. Do you think the same way, or?
100%. Just keep going.
All right, awesome. So I like both, but I prefer the by far. If I had a choice of any one thing, it would be across the board a portfolio of single family detached homes. Now, some people might say you're nuts. That's just too much.
I hear it all the time.
Yeah, that's too much to track, too much to manage. Well, you know what? I don't have to manage it all myself, and I don't have to track it all myself. There are tools that simplify it, and then you've got a bookkeeper, your accountant, and your attorney, and they manage parts of it. So really, I'm like the CEO of my company, and I'm looking down and talking to my frontline, team, my providers and whatnot, who are managing my assets and controlling things. Now, I control everything, but I have the team to help me, so I don't spend a lot of time on it. But those are really the two avenues that investors can go down. I'm not going to say one's right or wrong, and I'm not going to tell you where you should focus. But I do like the single families, duplexes, and fourplexes the most, because the financing's better, the cap rates are better, they're more abundant, by far more abundant, less competitive, far more nimble, and you can just find them in every single market quite easily. So that's where
it's just interesting, because I the whole time during this conversation, I thought for sure your answer was going to be the multifamily, and I'm really happy you said that.
Okay.
because that's all we invest in. I used to do the big multis, and I sold them all, and now we only do 1 to 4s. I mean, I've had some bigger units, but I've sold every one. And the exact reasons you said why you do the 1 to 4 is the exact reason I do. The nimbleness. The liquidity is the number one reason. If I own a giant apartment complex and I get in trouble, where am I going to go? If I'm in a down economy, banks aren't lending, and I got a value going down, I'm dead in the water. I'm going to lose the property. If I got a bunch of single families, you always have a buyer. You always have a buyer, and you always have a renter, because that's just what people are looking for. And I think even more so now with what's happening, you're going to see that space, the singles and the doubles and the quads. I also like the singles. I mean, my best renters, my best performing assets are my single family houses. And people say I'm crazy. Why would you want all those doors, all those roofs, all those, issues? I'm like, funny. We renovate all of our properties, so I really don't have those issues. Nobody's really ever calling me with problems. They treat these houses like their own because it's a house. And I don't know, because I like it, because it's easy. And when I want to sell it, you know what I do? Somebody moves out, I put it on the market, and the house is gone. I'm doing it right now. I'm liquidating a lot of stuff because I think the market's at a high point, and I think it's going to contract, and I think it's going to go down. I think I said that right. Contract,
Yep.
Retract,
Yep.
contract. So it's going to go down. I had to catch myself there, and I want to buy again at those levels like I used to, but I want to do it knowing what I know. So I just thought that was interesting. I just did not think that was going to be your answer, and I'm happy it was, because I mean, all the listeners, I get a ton of people that are big multifamily people, and that's what they're after. And that's great. I've run the numbers. I've literally taken unit for unit, and I've run the numbers, and I beat them every single time in a return standpoint. And maybe I'm crazy. I'm not running my numbers wrong, but yeah, maybe their maintenance is a little bit less because they got one roof, and I've got however many it is, 40 for 40 properties, but my return's better. My nimbleness is better. My liquidity is better. My appreciation could also be better, but that could be argued on the, because they can drive the cap rates up. But I can portfolio my properties together, and I can do the same darn thing, which I've done. I've sold off portfolios of my properties just to liquidate quicker. I don't know. I love that. So we could talk. That'd be another 3-hour conversation going there. But with that being said, just as we're getting to the end, let me ask you, during your journey, what was the biggest external obstacle that you've had to face in the 16 years or longer, actually?
The biggest external obstacle in my journey? What would be the
one external obstacle that you had to face that was your biggest one?
Oh, man. I mean, we all have obstacles. I'm not sure what my biggest one would be. The management, having the right team is certainly one of the factors. I don't know if that was the biggest one, but having the right team is important because, I refer to the, 5 key, there's about 10 players on your team, but there's 5 key. One is, where you get your deals from, who or what. The second is your property manager. And I've had issues with property management over the years in many different ways. One is the story I just told you. The second is property managers that, sound great in the beginning and start off on the right footing, but then they, get distracted, derailed, something happens, they just fall off the rails and, things go a little sideways. So you live and die by your property manager. It's critically important. I think they're the most important person on your team. So having the right person there is important. But I've, had issues with, tax advisors in the past as well, where, they just don't understand real estate investing and the tax benefits that come along with it. They know how to fill out forms and file taxes and do the basic stuff, but they're not really giving you good tax advice. So, you have to educate yourself to understand what their role is and to be able to ask intelligent questions so you can properly screen and hire the right person as a tax advisor. And that's very important because, taxes are probably your biggest expense, or certainly one of your biggest expenses in life. If you make income, if you don't know how to protect that income and defer or reduce or eliminate your taxes, you're bleeding a lot. You're losing money, and that money could be reinvested to further grow your passive income and further grow your portfolio size and your wealth. So having the right tax advisor is critically important. And I didn't have the right person. I had to change that person a couple of times. And so, that's, I don't know if I call that a mistake. It's just a lesson learned. So that's
it's
important.
An obstacle. Yeah, it's an obstacle.
It can be an obstacle. Yeah, I guess you're looking for obstacles. I'm calling these mistakes, but really, I guess they were obstacles in a sense because it prevented me from doing more faster. I didn't know what I didn't know at the time. The interesting thing I'd like to ask people is, and I do this in my presentations, I ask them to fill in blank on a sentence I put on a PowerPoint, and ignorance is blank. And I just pause and I wait for people to answer. And I'm sure you know what the most common answer is, right? Ignorance is bliss. Yeah, bliss. People say bliss. And then I say, well, yeah, that's what you hear, but that's not true. Ignorance is expensive because what you don't know is costing you a lot of money. It's causing you to lose the money you make, and it's costing you in terms of opportunity costs, opportunities lost. You don't recognize what you should be seeing. So you need to educate yourself, and that knowledge plays into the whole fact of not being ignorant. And then now ignorance is now no longer expensive for you.
Yeah.
So that, and that was an obstacle for me too. I mean, you learn as you go and you learn through experience, but you have to gain the knowledge from both book smarts, podcasts like yours, and the free resources that are available everywhere online. You just need to continually educate yourself. And so that shouldn't be an obstacle for most people because there's tons of good content out there. But I don't know. I don't want to say that I've been lucky or fortunate that I haven't had, huge obstacles. I think I've just been focused on the big picture, and I looked at every obstacle as a speed bump, not as an obstacle. A brick wall to someone is really just a bump in the road for me because I know I need to get over it, under it, around it. I'm going to get through it one way or another. So don't let it stop you.
I love it. So with that being said, how would people go about getting a hold of you if they want to learn more about your company?
Yeah, really, it's just the 2 websites. All our contact information is there, contact forms, free downloads, the book that's coming out, which is a free book, the podcast, everything is there. Those 2 websites are noradarealestate.com. And then the sister website is passiverealestateinvesting.com. And again, that's the name of the podcast. So that's the whole reason it's there.
And I'll put that in the notes too. So any of you that are looking to learn more about Marco and his companies, we'll have that in the notes. So you can just check out those. And that new book, that could be an interesting one. Grab a copy of that. But with that being said, we're at the top of the end of this show. So I just want to go back to all of you watching. On your journey to becoming a rebel banker, you got to take action. One of the things that we've created for you is Money School TV. MSTV might single-handedly be one of the greatest financial resources that people can use to give you up-to-date, to-the-minute financial knowledge on what is happening and what you need to be doing to make your money work harder and smarter for you. It's all about getting back control of your money, because we're not taught to be in control of our money. We're taught to give up control. So if you want to learn more about money and how money really works and how you can change your life, just changing your game with money, then join us for MSTV. And you can do that by going to moneyschoolrei.com/TV. It's a whopping $19 a month or $190 a year. And when you get in, if you're thinking, wow, that sounds too cheap and it must not be that good, all I can tell you is this is one of my greatest works of art, and it is more than you'll ever even know. And it also gives you 2 hours of coaching. So join us for the community. Money School TV, that's what you should be looking at to take action. So with that being said, Marco, thank you for your time. And thank you all for joining us for another episode of the Real Estate Money School. We'll see you next time.
Thanks, Chris. Appreciate it.
You're welcome.